Imagine discovering that one of America's most valuable assets is still recorded in government books at a price set more than 50 years ago. Not $100. Not $1,000. Just $42.22 per ounce. Now compare that to today's market, where gold trades at thousands of dollars per ounce. How can both numbers exist at the same time? Is it simply outdated accounting, or does that tiny number reveal something much bigger about money, confidence, and the way the global financial system works? At first glance, it sounds like nothing more than a bookkeeping curiosity. But the deeper you look, the more fascinating the story becomes. Because this isn't really a story about gold. It's a story about trust. It's about why governments continue holding thousands of tons of an asset that pays no interest. It's about why central banks around the world still treat gold as one of their most important reserve assets. And it's about why understanding one number, $42.22, may completely change the way you think about modern money. Today, we're going beyond headlines, political opinions, and market hype. We'll uncover the history behind America's official gold valuation, explore why that number has never changed, and examine what it tells us about the evolution of the global monetary system. Because sometimes the most important lessons in finance aren't hidden inside complex charts. They're hidden inside numbers that almost nobody stops to question. Every year, the United States Treasury publishes reports detailing the nation's financial position. Most people never read them. Investors focus on stock prices. Economists debate inflation. News outlets cover interest rate decisions. Yet buried inside these public documents is a number that has remained remarkably unchanged for decades. The U.S. government's gold reserves are officially carried at $42.22 per troy ounce. For anyone following today's gold market, that figure immediately raises an obvious question: why? After all, the market value of gold has changed dramatically over the past half-century. If you walked into a bullion dealer today, you wouldn't buy gold anywhere near $42 an ounce. So why does the official number remain frozen in time? The answer takes us back to one of the most important turning points in modern monetary history. For much of the 20th century, the international financial system operated under a framework in which the US dollar had a formal relationship with gold. Governments, central banks, and international institutions relied on rules that were very different from today's floating exchange rate system. Over time, however, economic growth, expanding global trade, and increasing government spending placed enormous pressure on that arrangement. By the early 1970s, maintaining the old system had become increasingly difficult. The United States eventually ended the dollar's convertibility into gold, marking a profound shift in the global monetary order. From that point forward, major currencies were no longer tied directly to gold in the way they once had been. Yet one thing remained: the accounting value used for the government's gold holdings. Instead of being updated each time the market price changed, the official valuation stayed at its statutory figure. That distinction is incredibly important. The accounting value isn't intended to reflect the current market price. It's a legal valuation used for government accounting purposes. In other words, the official number and the market number serve different functions. Understanding that difference prevents one of the most common misconceptions surrounding America's gold reserves. But while the accounting explanation is straightforward, it naturally leads to another question. If the government isn't valuing its gold at current market prices, what does that tell us about the unique role gold still plays inside the financial system? To answer that, we need to look beyond accounting and explore something much more fundamental: confidence. When most people think about gold, they immediately think about its price. Will it rise? Will it fall? Is now a good time to buy? Those are understandable questions. But they often overlook something much more significant. Historically, gold's importance has never depended solely on its market price. Its significance comes from the role it has played during periods of economic change. Unlike a company's stock, gold doesn't represent ownership in a business. Unlike a bond, it isn't a promise from a borrower to repay debt. Unlike paper currency, it isn't created through monetary policy. For thousands of years, gold has occupied a unique place in the global financial system because it exists independently of any single government's balance sheet. That doesn't make it perfect. Gold can be volatile. It can spend years rising or years falling, but its characteristics are different from many other financial assets. This difference helps explain why central banks across the world continue to hold substantial gold reserves. These institutions aren't trying to maximize quarterly returns. They're managing national reserves with decades, not months, in mind. Their responsibilities include maintaining confidence, supporting financial stability, and preparing for a wide range of possible economic conditions. That's a very different objective from trying to outperform the stock market over the next 12 months. Consider how people think about insurance. Most homeowners hope they'll never need it. Yet they continue paying premiums because the purpose of insurance isn't to generate profit. It's to provide protection against uncertainty. Many economists and investors have used a similar analogy when discussing gold's historical role within diversified reserve management. Not because gold guarantees safety, not because it always outperforms, but because it behaves differently under certain economic conditions. This perspective also helps explain why debates about gold often become debates about confidence itself. Confidence in inflation remaining under control, confidence in government finances, confidence in monetary policy, confidence that today's financial system will continue functioning smoothly tomorrow. Throughout history, periods of strong confidence have often encouraged investors to focus on growth and innovation. Periods of declining confidence have encouraged greater attention to preservation and resilience. Neither environment lasts forever. Markets move through cycles. Economic priorities evolve. Policies change. That's why experienced investors often spend as much time studying history as they do studying current market data. History doesn't tell us exactly what will happen next, but it helps us understand how financial systems have responded to major transitions before. And perhaps that's the biggest lesson hidden behind America's official gold valuation. The number itself isn't a prediction. It's a reminder that today's monetary system has a history, a reminder that financial rules evolve over time, and a reminder that some of the most important questions in investing aren't about tomorrow's price, but about the long-term foundations of confidence, money, and value. If America's official gold valuation helps explain the origins of today's monetary system, the next question becomes even more significant. Why do central banks still hold such large quantities of gold in the 21st century? We live in an era defined by digital banking, artificial intelligence, algorithmic trading, and trillion-dollar technology companies. Capital moves across the globe in seconds, financial markets operate almost continuously, and governments have access to sophisticated monetary tools. Yet despite these extraordinary advances, gold continues to occupy a meaningful place on central bank balance sheets. Understanding why requires looking beyond technology and focusing on the broader objectives of reserve management. Unlike individual investors, central banks are not primarily concerned with maximizing investment returns. Their mission is far more complex. They are responsible for preserving confidence in the nation's currency, maintaining financial stability, managing foreign exchange reserves, and ensuring they can respond effectively to unexpected economic challenges. This fundamentally changes the way they think about investing. Rather than searching for the highest performing asset, central banks seek resilience, the ability to withstand a wide range of economic conditions. Imagine being responsible for protecting the financial foundation of an entire country. Would it be wise to concentrate every reserve asset in a single currency, one economy, or one financial instrument? Most likely not. A diversified reserve portfolio provides flexibility, reduces concentration risk, and improves the ability to respond when global conditions change unexpectedly. This philosophy has guided professional reserve management for decades. Diversification is not an attempt to predict the future, it is a strategy designed to prepare for uncertainty. Within that framework, different reserve assets fulfill different roles. Some provide liquidity for international transactions. Others generate income through interest payments. Government bonds often contribute stability and are widely used in reserve portfolios. Gold, however, occupies a unique position because it possesses characteristics unlike many other financial assets. Unlike sovereign bonds, gold is not another country's liability. Unlike paper currencies, it cannot be created through monetary policy. Its supply expands gradually through mining rather than through government decisions, giving it qualities that many central banks continue to value within a diversified reserve strategy. This explains why gold remained part of official reserves even after the collapse of the gold standard. Many people assume that once currencies were no longer directly linked to gold, the metal lost its monetary significance. In reality, its role simply evolved. Instead of serving as the foundation of the international monetary system, gold became one component of a broader reserve management framework. It no longer defines the value of currencies, but it continues to contribute to the resilience of national balance sheets. A useful comparison is the construction of a modern building. Engineers do not rely on a single material to provide every type of strength. Concrete offers durability, steel provides structural support, and other materials contribute flexibility and protection under different conditions. Reserve management follows the same principle. No individual asset can meet every objective. A resilient reserve portfolio combines different assets because each performs differently under varying economic circumstances. Gold complements rather than replaces modern financial assets, adding another layer of diversification to an increasingly complex global system. Another reason gold remains relevant is the simple reality of uncertainty. Not fear, not panic, but uncertainty itself. The global economy has become more interconnected than ever before. Trade links nations across continents, financial markets react instantly to developments anywhere in the world, and geopolitical events can reshape supply chains, energy markets, and investment flows almost overnight. Because uncertainty cannot be eliminated, institutions prepare for it. Preparation does not imply expecting disaster, it reflects the recognition that the future rarely unfolds exactly as anyone predicts. History consistently reinforces this lesson. Few economists anticipated the full scale of the global financial crisis before it unfolded. Very few predicted the unprecedented economic disruption caused by the pandemic. Likewise, the rapid return of inflation after years of relative price stability surprised many policymakers and market participants alike. These events remind us that unexpected developments are not rare exceptions, they are recurring features of economic history. Successful institutions therefore focus less on forecasting every possible outcome and more on building systems capable of adapting to a wide range of scenarios. Resilience, in this context, means maintaining flexibility regardless of which path the economy ultimately follows. Gold has historically contributed to that resilience because its behavior has often differed from that of many traditional financial assets during periods of significant economic stress. This does not mean gold always performs well during uncertainty or that it consistently outperforms stocks, bonds, or other investments. Like every asset, gold experiences periods of strength and periods of weakness. However, from the perspective of reserve management, diversification is generally more valuable than attempting to maximize returns through any single investment. This long-term perspective also explains why investors closely monitor central bank behavior. It is not because central banks possess perfect foresight, they certainly do not. Like all institutions, they make decisions based on incomplete information and uncertain futures. What distinguishes them is their investment horizon. Rather than reacting to daily headlines or short-term market volatility, central banks evaluate structural trends that may influence financial stability over many years or even decades. Their decisions often reflect long-term risk management rather than immediate market expectations. For individual investors, there is an important lesson in that approach. Financial news encourages constant reaction. Every day brings new forecasts, urgent predictions, and dramatic market narratives. Yet history suggests that long-term investment success has rarely depended on responding to every headline. Instead, it has been built on discipline, diversification, patience, and an understanding of broader economic trends. While market conditions change continuously, these principles have remained remarkably consistent across generations. That is why discussions surrounding central bank gold reserves continue attracting attention around the world. The most meaningful question is not whether each new purchase predicts an immediate increase in gold prices. Rather, it is why institutions entrusted with safeguarding national financial systems continue believing that gold deserves a place alongside currencies, government bonds, and other reserve assets. The answer lies not in speculation, but in sound risk management, diversification, and long-term planning. Perhaps the greatest misunderstanding about gold is the belief that it simply competes with stocks or bonds as another investment seeking higher returns. Professional reserve managers generally view it differently. Gold represents one component within a much broader strategy designed to strengthen resilience under changing economic conditions. Once viewed through that lens, the conversation shifts away from short-term performance and toward a more fundamental question: why has gold remained relevant across so many different monetary systems for so many decades? The answer cannot be found within a single market cycle or a single economic forecast. It is the result of generations of experience, repeated financial transitions, and the recognition that while technology continues transforming global finance, one principle has remained remarkably constant. Confidence is strongest when preparation comes before uncertainty, not after it. And that understanding naturally leads to the next chapter, where we examine how confidence, monetary policy, and the evolution of the international financial system have quietly shaped gold's role for more than half a century. For thousands of years, gold has represented something far more profound than wealth. It has symbolized trust. Unlike paper currencies, which depend on governments, or bonds, which rely on borrowers honoring their obligations, gold has maintained its place in human history through its independence from any single institution or political system. During periods of economic stability, gold often fades into the background as investors focus on growth, innovation, and financial assets. But whenever confidence begins to weaken, whether because of inflation, excessive debt, currency instability, or geopolitical uncertainty, gold inevitably returns to the center of financial discussion. Its enduring importance lies not only in its scarcity, but in humanity's repeated search for an asset whose value is less dependent on promises and more grounded in permanence. Understanding gold requires first understanding the nature of money itself. Throughout history, money has taken many forms, from shells and precious metals to paper currency and today's digital transactions. Despite these transformations, every successful monetary system has relied on one invisible but essential ingredient: confidence. Currency functions because people believe it will continue to be accepted tomorrow. Government bonds retain value because investors trust that governments will repay their obligations. Banks operate effectively because depositors believe their savings are secure. The financial system is ultimately built on trust. When that trust is strong, people focus on investment opportunities and economic growth. When confidence begins to weaken, however, priorities change. Instead of asking how much their money can buy today, people begin asking whether it will preserve its purchasing power in the future. It is during these periods of uncertainty that gold has historically become most significant. For much of modern history, gold was not simply an investment, it was the foundation of the international monetary system. Under the gold standard, national currencies were directly linked to fixed quantities of gold, limiting governments' ability to expand the money supply without consequence. Because currency could be exchanged for physical gold, excessive money creation risked undermining confidence and triggering demands for conversion into gold reserves. In this way, gold served as a financial anchor, imposing monetary discipline while providing stability for international trade. During the 19th and early 20th centuries, many major economies operated under various forms of the gold standard. However, periods of war, economic crisis, and financial stress exposed the system's limitations. Governments increasingly sought greater flexibility to finance spending, stimulate economic activity, and respond to emergencies. Eventually, the restrictions imposed by gold became incompatible with modern economic management, leading many nations to move away from direct gold backing. Following World War II, the Bretton Woods Agreement established a new international monetary framework centered on the US dollar. Under this system, the dollar became the world's primary reserve currency and remained convertible into gold at a fixed price, while other major currencies were linked to the dollar. This arrangement provided decades of relative stability and facilitated global trade. The United States, holding the largest official gold reserves, became the cornerstone of the international monetary order. Over time, however, expanding fiscal obligations, rising government spending, and an increasing supply of dollars raised doubts about America's ability to maintain gold convertibility. In 1971, President Richard Nixon suspended the dollar's direct convertibility into gold, effectively ending the Bretton Woods system and ushering in the era of floating exchange rates. For the first time in modern history, the world's dominant reserve currency was no longer directly backed by a physical asset. Instead, the global financial system became based primarily on confidence in governments, central banks, and their institutions. Today's monetary system is built on fiat currencies, money that derives its value from government authority and public confidence rather than a direct link to gold. This framework provides central banks with powerful tools to manage economies. They can adjust interest rates, expand liquidity, and implement policies designed to stabilize financial markets during periods of crisis. Such flexibility has proven valuable in responding to recessions and financial shocks. At the same time, it introduces new risks. If the money supply grows significantly faster than economic output, inflation may erode purchasing power over time. Individuals may see higher balances in their bank accounts while finding that those balances purchase fewer goods and services. This relationship between inflation and purchasing power helps explain why gold has historically attracted attention during periods of monetary expansion. Gold generates no cash flow, pays no dividends, and earns no interest. Instead, many investors view it as a potential store of value when confidence in paper currencies begins to weaken. Inflation represents far more than rising prices, it reflects a gradual decline in the purchasing power of money. Over long periods, even moderate inflation can significantly reduce the real value of savings. This is one reason many investors consider gold a form of monetary insurance rather than simply another investment. During times of elevated inflation, attention often shifts toward assets that have historically helped preserve purchasing power. The inflationary decade of the 1970s offers one of the clearest examples. Following the collapse of Bretton Woods, oil shocks, rising consumer prices, and widespread economic uncertainty contributed to declining confidence in traditional monetary stability. As gold transitioned from a fixed official price to a freely traded market asset, its value increased dramatically over the course of the decade. The broader lesson was not merely that gold appreciates during inflation, but that declining confidence in money often leads investors to seek alternative stores of value. One of the most fascinating aspects of today's monetary system is that central banks continue to hold substantial gold reserves despite operating within a fiat currency framework. At first glance, this appears contradictory. Modern economies rely on paper currencies, yet the very institutions responsible for managing those currencies maintain significant allocations to gold. The explanation lies in reserve diversification and risk management. Gold carries no government liability, cannot be created through monetary policy, and is not dependent on another country's fiscal position. For nations managing foreign exchange reserves, gold represents an asset that exists outside the obligations of any single government. This characteristic becomes particularly valuable during periods of geopolitical tension, financial sanctions, currency disputes, or uncertainty regarding the future structure of the international monetary system. Gold provides an additional layer of resilience by diversifying reserve portfolios beyond traditional financial assets. The international monetary system itself continues to evolve. Global economic power is becoming increasingly multipolar as emerging economies expand their influence. Countries are reassessing reserve management strategies, exploring digital currencies, strengthening regional trade relationships, and reconsidering the composition of their international reserves. The central question is not whether gold will replace modern currencies, such an outcome appears unlikely, but rather what role gold will continue to play within an increasingly complex and changing financial landscape. History suggests that gold does not need to replace money in order to remain important. Its significance grows when confidence in existing monetary arrangements is tested, offering diversification and stability during periods of transition. Ultimately, the story of gold is the story of confidence itself. Across civilizations, monetary systems, and centuries, empires have risen and fallen, currencies have been introduced and abandoned, and financial systems have been repeatedly redesigned. Yet gold has endured through every transformation. Its survival is not evidence of perfection, nor does it imply that gold solves every economic challenge. Instead, it reflects humanity's enduring desire for an asset that exists independently of political promises and institutional commitments. When confidence in financial systems is strong, gold often remains quietly in the background. When confidence begins to weaken, however, its historical role becomes increasingly visible. Every major monetary transition has reinforced the same enduring lesson: modern money is built on trust, but gold derives its significance from the long passage of time. For much of the 20th century, gold was often dismissed as a relic of an earlier financial era. As economies modernized, technology transformed industries, and global markets became increasingly sophisticated, many assumed that gold had lost its importance. It remained quietly stored inside central bank vaults while attention shifted toward stocks, bonds, digital payments, and innovative financial products. Yet beneath the surface, something remarkable was happening. The very institutions that built the modern monetary system never abandoned gold. Instead, they quietly redefined its role. Rather than serving as the direct foundation of currencies, gold became a strategic reserve asset, one valued not for generating income, but for strengthening resilience in an increasingly uncertain world. Today, central banks across the globe continue to maintain, and in many cases expand, their gold reserves. This trend highlights a deeper reality about the international financial system. Even in an age dominated by digital banking, artificial intelligence, and highly advanced capital markets, governments still place considerable value on an asset that exists independently of any country's political or monetary decisions. Gold has evolved beyond its traditional role as a hedge against inflation. It has become a symbol of financial independence, offering reserve managers an asset that does not rely on the creditworthiness, policies, or promises of another nation. For decades, the US dollar has served as the cornerstone of global finance. International trade, commodity pricing, energy markets, sovereign reserves, and cross-border lending have all been heavily influenced by the dollar-based monetary system. This position has provided the United States with significant economic advantages, including lower borrowing costs, greater financial influence, and a central role in global capital flows. However, like every monetary system throughout history, the current framework faces evolving challenges. Rising government debt, shifting geopolitical relationships, and increasing competition among major economies have encouraged many countries to reconsider how they structure their national reserves. Rather than abandoning the dollar altogether, many policymakers appear to be seeking greater diversification by reducing reliance on any single currency. It is within this broader context that gold has regained strategic importance. Gold provides something that no fiat currency can offer: independence from the policies of another government. Unlike foreign currencies, gold cannot be frozen, sanctioned, or expanded through monetary policy. It is not tied to the fiscal decisions of any one nation, making it an attractive component of reserve diversification. For governments navigating an increasingly complex geopolitical landscape, gold represents a form of financial neutrality. Its value lies not only in its physical scarcity but also in its ability to exist outside the liabilities of modern financial systems. The actions of central banks provide an important insight into this evolving landscape. When individuals purchase gold, the decision is often described as a reaction to uncertainty or fear. When central banks increase their gold holdings, however, the motivation is generally viewed quite differently. Institutions responsible for managing national reserves operate with long-term objectives measured in decades rather than months. Their decisions are based on extensive analysis of economic trends, geopolitical developments, financial stability, and systemic risk. When reserve managers choose to increase gold allocations, they are not necessarily predicting an imminent crisis. Rather, they are acknowledging that a diversified reserve portfolio may provide greater resilience in a world where future uncertainties cannot be predicted with precision. Gold's significance extends beyond institutional strategy. It also reflects fundamental aspects of human psychology. Financial markets are ultimately driven by expectations and confidence. A company's stock price reflects expectations about future earnings. A currency reflects confidence in a nation's economy and monetary policy. A government bond reflects confidence that future obligations will be honored. Gold represents something different altogether. It embodies confidence that exists outside the financial system itself. Because of this unique characteristic, gold has often behaved differently from many traditional financial assets during periods of economic stress. When uncertainty rises, investors do not always seek the highest possible returns. Frequently, they seek greater stability and protection against risks that are difficult to forecast. This leads to one of the most important questions facing investors today. Rather than asking whether gold will rise or fall tomorrow, a more meaningful question is how gold may behave if the global economy enters another period of significant monetary uncertainty. Gold's long-term outlook depends on forces far larger than short-term price movements. Inflation, interest rates, government debt, monetary policy, geopolitical developments, and, above all, confidence in financial institutions all influence its role within the global economy. These structural factors often evolve gradually, shaping investment decisions over many years rather than through sudden market events. Modern society has achieved extraordinary economic progress. Digital technologies have transformed commerce, financial innovation has expanded investment opportunities, and advances in artificial intelligence continue reshaping industries around the world. Yet beneath this remarkable progress lies a timeless economic principle: every financial system ultimately depends on trust. Without confidence, currencies struggle to maintain purchasing power. Financial markets become more volatile. Economic activity slows as uncertainty grows. Throughout history, periods of declining confidence have repeatedly encouraged investors and governments alike to revisit assets capable of preserving value outside conventional financial systems. Gold has consistently occupied that role, not because it guarantees returns, but because it offers an alternative form of financial confidence. The future monetary landscape will almost certainly differ from the past. Gold is unlikely to replace major reserve currencies or eliminate financial crises altogether. Nor does it guarantee profits for investors. Its importance, however, may continue evolving alongside changing global conditions. In an environment characterized by elevated debt, geopolitical competition, technological transformation, and shifting monetary policies, gold may increasingly serve as a form of financial insurance. Insurance is not purchased with the expectation of constant use, it is valued because it provides protection when unexpected events occur. Gold occupies a similar place within many long-term investment and reserve management strategies. Perhaps the greatest lesson offered by gold's long history is not about forecasting its future price. Rather, it is about understanding why societies repeatedly return to it during periods of uncertainty. Across thousands of years, civilizations have sought assets capable of preserving value across generations, surviving political transitions, economic disruptions, and monetary transformations. Gold has endured because it represents permanence within systems that are constantly evolving. Imagine standing inside one of the world's great central bank vaults, surrounded by thousands of gold bars. Each bar carries a silent history. Some were refined during times of economic prosperity. Others survived world wars, financial crises, inflationary periods, and political revolutions. Governments changed, currencies disappeared, financial systems evolved, yet the gold remained. This continuity illustrates gold's unique position in the history of money. Unlike paper currencies, it does not depend upon legislation, central bank policy, or government guarantees. Its strength comes from centuries of global acceptance rather than promises made by any individual institution. Today, the international financial system stands at another important moment of transition. Public debt continues rising in many economies. Monetary policies are adapting to changing inflation dynamics. Countries compete for technological leadership, economic influence, and strategic resources. Digital currencies and financial innovations are reshaping how money moves across borders. Against this backdrop, investors and policymakers are once again asking a familiar question: where can value endure when the financial landscape continues changing? For some, the answer lies in technological innovation or productive businesses. For others, it may include real estate or diversified financial assets. Yet throughout history, one answer has remained remarkably consistent. Gold continues to represent an asset whose value depends less on institutional promises and more on its enduring role as a globally recognized store of value. The future of money has not yet been fully written. New technologies will continue transforming financial systems, and new monetary arrangements may emerge over time. Nevertheless, history offers one lesson that has remained surprisingly constant. During periods of confidence, gold often receives little attention. During periods when confidence is questioned, however, its historical significance becomes increasingly apparent. That enduring pattern helps explain why gold has survived every major financial transformation humanity has experienced. Ultimately, gold is more than a precious metal. It is a reminder that every financial system rests upon one indispensable foundation: confidence. Markets function because people trust them. Currencies circulate because societies believe in their value. Institutions succeed because confidence supports them. Gold's unique place in financial history stems from its ability to exist outside those institutional promises while continuing to symbolize stability across generations. Whether its role expands or contracts in the years ahead will depend on how the global economy evolves, but its historical significance offers an enduring perspective on one of finance's most fundamental truths: lasting wealth is built not only on assets, but on confidence itself. Subscribe for more deep financial documentaries exploring gold, markets, global economics, and the hidden signals shaping the future of money.